Assalamu alaikum everyone. Good morning. How's everyone? Any question from the last class or any question which you want to ask? By the way, our today's topic is merger and acquisition. First of all, we will revise its theory. Then we will solve a question on it. So let me quickly move to the P4 notes. These are our P4 notes. So let me move to the page number 64. Okay, this is merger. So the theory of merger is very important, but like there is only 10% chance that examiner can test straightforward theory from it. But obviously, always remember, if you read the book, if you read the past papers, it will definitely help you out in the final exam. So in merger, you should know there are three different types of merger. Horizontal merger, when two similar nature of businesses combine together, that is horizontal integration. Vertical integration is when in a supply chain, one company acquires the other company to strengthen its supply, to strengthen its either supply or demand. For example, if the customer acquires the supplier or if the supplier acquires the customer, that is the vertical integration. Conglomerate integration is like when one company acquires the other unrelated business. When one company acquires the other unrelated business, that is called the conglomerate integration. So these are the three types of integration. You should know that it has never been tested in the exam, but the next topic, the growth strategy, has been tested in the exam. You should know that there are two types of growth. One is the organic growth and other is the inorganic growth or the growth through acquisition. Remember, organic growth is if you grow over the period of time by your own, that is called the organic growth. Organic growth allows planning of strategic growth in line with stated objective of the company. So in organic growth, you will state your objective and over the period of time, you will achieve those objectives by making a good strategy. It is less risky because you will achieve those objectives over the period of time by making different experiments. Cost is lower in organic growth because it is incurred over the period of time. Organic growth avoids problem of integrated new acquired businesses. By organic growth and immediate pressure on the current management resources to learn the manage the new business will be avoided. Look, it's a very important problem. If I acquire your business, so my demand will be your people, your employees should immediately learn my system, my way of doing things, my culture. So it will be a pressure on you that you have to learn the new system. And it is very difficult to teach the management. It is very difficult to teach the old employees. So in organic growth, that is not the case because in organic growth, learning will be over the period of time. But for example, if one accounting body and the two accounting bodies combine together, for example, if ICW and ACCA combine together and ICW acquires the ACCA and ICW says that now you people do not have to learn AFM. Now you have to learn my paper. So obviously we still think that AFM is difficult. That then at that time, how we are going to learn the new subject? It will be difficult for us. It will create pressure on us. Many of us will leave that company, will leave that process because of the pressure. So that will happen in the organic. That will not happen in the organic. Disadvantage, it requires times to enter a new product or the new market. It increases the risk of oversupply and excessive competition, because if I am organically growing, you and other companies are also organically growing. So it will sooner or later, it will create oversupply, excessive competition. It increases the competition as more competitors are in the market. Organic growth might result in low market power as compared to the acquisition strategy. Organic growth may give lesser competitive edge as compared to the acquisition. How? I will explain it. So similarly, the advantages of inorganic growth is growth through acquisition. It is the quickest way to enter a new product. It is the quickest way to enter a new product. For example, you know that the new software chat GPT has been launched. So you are the other big company. So if you want to launch your own software, that is organic growth. And if you want to acquire the other second best software, that is inorganic growth. So what is the quickest way to enter into competition? Acquiring the other company. It reduces the risk of oversupply. For example, if there are 10 companies in the market and one company acquires the other, then now there are 9 companies in the market. And if one company acquires the other company, now there are 8 companies in the market. So what will happen if companies start growing through acquisition? It will reduce the competitors. It will reduce the oversupply. It will reduce the excessive competition. Acquisition result in decreased competition. Acquisition result in increased market powers. Now there will be low number of players in the market. So if low number of players, lesser number of players, so it will reduce the competition. Okay, acquisition result in the acquisition of the target company staff and highly trained staff may give a competitive edge. If you acquire the other company, it will give you the competitive edge because you have acquired the skills of the other company staff. Obviously, the advantage of organic growth will be the disadvantage of growth through acquisition. I have seen like 2 to 3 questions where examiner has asked the advantage and disadvantage of these growth strategies. I still remember the name of one company. If you have a time, do go through one of the question. That question name is Vogel Company, VOGEL. The A part of Vogel Company is from this area. A part. Okay, next is you should know the reason for acquisition. Synergy is the main reason, but there are other reasons. Enter into a new market to acquire the company staff, managerial motives, hubris hypothesis. What is this? Managerial motive is if I'm the manager of the company, I want to enhance my area of interest, my skills. I want to enhance my skills. So what I will do, I will acquire the other company. Now I can say previously I was the CEO of the textile company. Now I'm the CEO of the textile and the cement company. And if I acquire the other company, now I will say I'm the group CEO because I have in my portfolio textile, power, and the cement company. So managers acquires other companies so that company can dependent on that. Look, let me tell you, if I'm the finance guy and you are the very rich person and you are starting a company, you hires me. For example, you hire me and I'm the financial controller of your company. I will start some innovative, difficult, or unique type of project. And I'm the only one who can run those projects. So you as an owner will always feel pressure that this is the man who can only run these projects. If I fire him, I will unable to complete the projects. That is managerial motive. Employee start some unique projects. Employees sometimes, managers sometimes do some unique things, so that the owner of the company thinks that we are dependent on these employees. We cannot fire them. That is managerial motive. What is arrogance? Arrogance is, if I'm the CEO of the company, I will think that I'm the champion. I'm the king of the company. And you know from the past movies that king attitude is arrogant, right? King is arrogant. And what king will do? King will invade other countries to maximize the kingdom, to maximize the size of the kingdom. Similarly, the CEO will do the same thing. CEO will try to acquire the other company so that his kingdom increases, so that he can earn more perks and benefits. Another reason for acquisition is diversification, maybe a defense mechanism, maybe improves the liquidity. If, for example, I'm not, for example, my company is not having a good liquidity, but the other company is having a good liquidity. So I will issue my shares to acquire the other company. I will, at the same time, I will acquire the company as well as the liquidity of the other company. These are the other reasons: improved ability to raise finance. For example, if you acquire the other company, overall risk decreases. If overall risk decreases, the debt capacity may increase. A reduction of risk by acquiring substantial asset. Let me explain this. For example, your company has some intangible assets. For example, your company is a software-based company. It's a very good company, but intangible assets are always risky. You know that. So if you acquire the other company which has substantial fixed asset, what will happen? It will reduce the risk. So that's why you're acquiring the other company. To obtain a growth company, for example, if the other company is growing and your company growth is not that great, so you will acquire the other company to get the growth. So these are the benefits, but these are not very important. You should read at least once. Synergy benefits are very, very important. There are three types of synergies. Broadly, the main category, there are three types. Revenue synergy. If I acquire your company and my company will become bigger company, and now our revenues will grow. How? There are three reasons. Increase market power. Increase market power. How it will increase the market power? Increase market power means, if, for example, my company is a textile company operating in Pakistan, and I'm exporting the products to the USA, and your company is also operating in Pakistan, you are exporting products to the Europe. Now, when our companies combine together, we can market, sorry, this is marketing synergy, second point. We can market now. My company also market to the Europe. Your company can also market to the US. That is marketing synergy. Market power is, let me explain this. Market power is, for example, this is A company. A company is holding a share of 50%. This is B and C company. Guys, give me 1 minute, please. Okay, for example, A company is a 30% share, B company has, let's say, 40% share, C company 10%, D company 10%, and E company 10%. So what is market power? If these companies combine together, they combinedly have 70% shares. So what will happen? What is market power? Whenever a new customer appears, there is 70% chance that this business will capture the new customer. That is market power. you are having a major market share. So what you can do, you can dictate the price. You can dictate the price. You can dictate the market by your own terms. So that is called the market power. Strategic synergies. Strategic synergy is you are offering two products. The other companies like I'm offering the AFM, FM, and CFA. I am offering three products. For example, the other institute is offering ICW and maybe the other course. If we combine together, our whole shop will offer you five products overall. So that is strategic synergies. Now the chances of new customer will increase because our shop is offering you more products. That is strategic synergy. It is like exactly similar, the small shop or the big shopping, big like Walmart, or if there's a big shopping center compared to a small shop. Big shopping center will have a strategic synergies. That is revenue synergy. Cost synergy is very simple. Two companies combine together. You will redundant few staff. You will there will be a cost saving of admin department, operation department. You can save the rent. And if you have acquired the similar other companies, there can be economies of scale benefits. Financial synergy is number one benefits diversification. It is debatable. So let me explain it. Diversification means when you acquire the other company, it will give you the diversification benefit. Remember, you will always write diversification is the role of shareholder. Shareholder will always diversify their wealth. It is not the role of the company. Remember this. But if your company is a closely held company, what is closely held company? Having very few shareholders. Your company has only few shareholders, like one or two shareholders. And if your company is doing the diversification, it will give the benefit to the shareholder, because shareholders has put all their wealth in the same company, in one company. And if that one company is doing the diversification, it will give the benefits to the shareholders. But if your company has many thousand shareholders, and if that company is doing the diversification, that diversification will not benefit the shareholder, because those shareholders have already diversified their wealth. So this diversification benefit is debatable. So guys, in many questions, you will find that there are institutional shareholders. Institutional shareholders. If your company has institutional shareholders, remember, institutional shareholders have always diversified their wealth. Institutional shareholders have already, that is a better word, already diversified their wealth. So if this company is doing the diversification, that will not give the benefit to the institutional shareholders. You will see this in many of the past exam paper questions. So remember, if your company has institutional shareholders, you can write that institutional shareholders have already diversified their wealth. If this company is doing the diversification, it will not give the benefit to the institutional shareholders. Because institutional shareholders mean the big companies, the pension house, the mutual funds. Those companies have diversified their wealth. They have already invested in many companies. Okay, next is cash lack. One company is lacking the cash, other company is cash rich. So if they combine together, they can create the synergy, tax benefits, debt capacity. These are very easy. Next is problem in achieving synergies, lack of unity at the top management, significant shareholding and a place on the board of any party might affect and create strong influence on the other party. That is also related to the problem at the board. You can say that differing remuneration package and change in employment condition result in problematic situation for the employees. Integration between staff of two companies. Guys, these points are very important. Even in today's question, you will find these points for discussion. Appropriate target for acquisition. We have discussed that. You can read that. It's very easy. Why acquisition fail? Let me explain this. Over optimistic assessment of economies of scale. If you are acquiring other companies and you estimate that you will get that much synergy benefits, but in reality, you could not achieve that benefits. That is over optimistic assessment of economies of scale. Once a company has been bought, management moves on to identify the next company rather than ensuring the protected synergies realized. So management is too busy in selecting the new company rather than realizing the previous business. That is also a problem. Inadequate preliminary investigation. You know that whenever you want to acquire the other company, you will hire a consultant. You will hire a big four like EY, KPMG, PwC. These companies will do the due diligence process. They will check the asset condition, liability, contracts, and then they will calculate the value, and then they will let you know whether you should acquire this company or not. You haven't done the proper preliminary investigation. So that's why your business can fail. Winner cuts. If you want to acquire the business at any cost, what will happen? You will pay more in order to acquire the company. So maybe because of that emotional bias, you may fail. Dominance of subjective factors. Some of the board members are too heavy on the board, and because of their strategies, your company may fail. It is linked to democracy and dictatorship. If the culture of your company is dictatorship type, so because of the personality of that board members, you may not realize the other companies' synergies. You may fail. Loss of key personnel, capital structure, integration difficulties. These are the key points. Guys, why acquisition fail? You have read that. But examiner is testing this question in a different style. How examiner will ask? Examiner will ask what a company can do to avoid the failure of acquisition. This is interesting, right? The question is how examiner will test what a company can do, what an acquirer can do to avoid the failure. So can you tell me the answer? What an acquirer can do to avoid the failure by looking at this. You are the acquirer. How can you avoid it? Anyone? I taught you why acquisition failed, but examiner is not asking this. He's asking what we can do to avoid the acquisition fail. Yes, we have to change the wording, right? Number one, we should do the educate preliminary investigation. We should hire a proper firm to do the proper due diligence. And we should apply different methods to get the proper valuation. Okay. We should ensure that there is not integration difficulties. We should ensure that capital structure will, there is no like excessive debt in the capital structure. So the risk of the company shouldn't control. We should ensure that the integration should be smoothly, that key employees should not left the company. We should ensure the package of the new employees, package of the incoming employees in such a way. We should build the package of the new employees in such a way that new employees may not leave the company. So we have to change the wording. Remember, in December 2022, this topic has been tested, but in a different way. We will discuss in after a few minutes. Okay, factor affecting the likely success of the bid. How can you make the bid successful? Obviously, number one, consideration. Increase the consideration. The acquirer should offer an initial bid price, keeping in mind satisfactory premium over and above the actual market value. If you are not offering the satisfactory premium, you cannot acquire the other company. Future dividend policy, shareholder of the target company may be sensitive to the dividend policy. So if the acquired company is not indicating the better future dividend policy, it is difficult for the target company shareholders to sell their shares to the acquirer. Tax position, shareholder also will see that whether what is their tax position, whether tax is charged on a capital gain or the higher tax is charged on the like share to share transaction. Change in share price. For example, if I'm the acquirer and you the target company, and I'm acquiring your company by exchanging my shares against your shares. So what you will see, my share prices are stable. If my share prices are volatile and or in a declining trend, you will not accept the share for share offer because it will not give you the benefit. Then these are the defenses. At least read it once. Poison pill. Poison pill is like taking a loss, taking a cost. Poison pill, this is an attempt to make a company unattractive normally. How? For example, if some other company is acquiring your company, so what you will do? You will issue more shares to the previous shareholder so that the proportionate ownership, the percentage share of the previous share owners will increase, and the company which is trying to acquire your company, their ownership will decrease. This is unethical. And why it is a cost? For example, this is your company. 80% shares are with your shareholders. 20% shares are with the acquirer. What you will do? You will issue new shares only to these 80% shareholders, not all. Obviously, it is unethical. In some countries, it may be it not allowed. And you will issue new shares to the previous shareholder at discount. That is the poison, at discount. What will happen? Their proportionate ownership will increase, their proportion will decrease. So that is poison pill. Poison. What is poison pot? Poison pot is this is your company, and some acquirer wants to acquire your company, and you want to save yourself. What you will do? You will ask your bondholder, if the acquirer acquires the company, they can pay back the loan. For example, at 30% premium. So there is a clause in the company's memorandum. What will happen? Acquirer will see that if they acquire the company, they immediately have to pay back the loan at 30% premium. So it will increase the cost of the acquirers. Maybe they stop. Staggered board of directors. Do not elect all the directors in the same year. Elect few directors in a year so that acquirer will take years to complete the board of directors at the board. So it's a time delay factor. Actually, golden parachute is you will give highest You will give higher perks, benefits to your management so that your management will work on your behalf. So golden parachute is, if you are my manager, what is my fear? Being the shareholder. The acquirer will contact you and you will start working on behalf of the acquirer. So what I will do to reduce this risk? I will give you the perks, benefits, your salary will be higher. I will give you some other additional benefits. So you will always work. You will always think for me. That is golden parachute. Then eternal vigilance, cross shareholding, strong dividend policy. Strong dividend policy and eternal vigilance is you will keep your share price high. If your share prices are high, it is difficult for other companies to acquire you. Cross shareholding is if you have a group, of companies, so some of the shares will be cross exchange between different companies. So if someone wants to acquire your company, that acquirer have to acquire the whole group. Otherwise, enough shares are not available in the market that you can buy that company. So, for example, if ABC company, XYZ company, MNO company, 3 companies. Some of the ABC company shares are held with XYZ. Some of the XYZ shares are held with MNO. Some of the MNO shares are held by XYZ. So all the 3 companies have distributed their shares to the other companies. So if you want to acquire this company, but some of its shares are present with this company and some of the shares are present with this company. So enough shares are not available in the market that you can acquire this. That is cross shareholding. Post offer is whenever somebody acquires to try to acquire your company, file a case against that company. Maybe you lose a case, but it will give you some time. Green mail is sending a friendship message. You will ask the acquirer that, okay, you have acquired few shares. Sell me that shares at certain price. I will not say anything. So green mail is sending like a friendship message. So if this is your company and acquirer has acquired like 20% shares, so you will ask the acquirer, sell me back these 20% share, for example, at premium. If price is 20, sell me that share at $25. And you will do the agreement that they will not do it again. So maybe in order to earn the premium, they sell the shares to you. Crown jewel defense. So other companies tries to acquire your company, and at that time, at that difficult time, at the time of survival, what you will do? You will sell your best asset. So makes your company unattractive. If your company has become unattractive, so at that time, other company may not acquire your company. Pac-Man defense, if somebody wants to acquire your company, in reverse, you will say, okay, I will acquire your company. Reverse acquisition. You are trying to acquire me, let me acquire you. That is Pac-Man defense. Pac-Man defense is like, it's more like a defense. You're not acquiring the other company, but you are threatening the other company actually. So maybe because of the threat, other company change its mind. White knight defense is you will involve your friend company that acquire my company shares so that I will save myself to selling to the other company. So your friend company will come, they will acquire your company shares. Now enough shares are not available in the market, so you will save yourself from selling to the other company. Mitigating risk if acquirer fails to increase shareholder value, do read it. This is a past paper answer. A company which pursues a policy of acquisition, it needs to determine whether or not this has been too aggressive and detailed assessment have been undertaken. Acquirer should ensure that valuation is based on reasonable input figures and that proper due diligence of the perceived benefit is undertaken. Often it is difficult to get an accurate picture of the target when looking at it from the outside. It needs to ensure that it has sufficient data and information to enable a thorough and sufficient analysis. Source of energy need to be properly assessed. Guys, this is the exactly opposite answer of this, which I was asking. Why acquisition failed? So this is the exactly answer. What you will do if company fails to succeed. The source of the synergy need to be properly assessed and to ensure that they are achievable and what action needs to undertake to ensure their achievement. This is especially so far for the revenue-based synergy. Assessment of the impact of the acquisition on the rest of the combined company needs to be undertaken to ensure that acquisition is not considered in isolation, but as part of the whole company. Board of directors needs to ensure that there are good reasons to undertake the acquisition. Post-completion audit may help to identify the reason behind why acquisition have failed. Once these reasons have been identified, strategies need to be put to prevent the acquisition, to prevent the same things in the future. Procedure need to be established to ensure that acquisition is not overpaid. Acquirer should determine the maximum premium it is willing to pay and not good beyond that figure. Okay. Often this is the result of the management of acquiring company wanting to complete the deal at any cost, because not completing the deal may be perceived as damaging to both their own and their company reputation. That is the case because of to save the image, sometimes you overpay. The acquiring company management may also want to show that costs related to undertaking due diligence and initial negotiation have not been wasted. Formal procedure need to be established which allow manager to step back without loss of personal reputation. So guys, this is the answer you can write if in examiner asks that what you will do in order to avoid the failure. This is the answer, which I asked like 10 to 15 minutes earlier. These are the acquisition risk. There are many risks in acquisition which have both a high likelihood of occurring. Disclosure risk. So you are acquiring the other company, but other company does not disclose all the information to you. So what will happen? If you unable to get all the information, your due diligence will wrong, your valuation will wrong. Valuation method. A substantial acquisition has the potential to alter the risk of acquirer either because of an alteration in the fund's exposure to financial risk or in exposure to market risk. Ultimately, the value of a company to its equity investor depends upon the potential return it offers. So if you haven't completed the valuation by different means and you have, if you value the company using a wrong method, it will damage the result. What will happen? Ultimately, you may end up paying the higher amount. So valuation risk. So next is types of financing. This is very important. Cash offer. You need to remember the advantage and disadvantage of cash offer, shares offer. Okay, these are important. Then this area can be tested in a very straightforward way. You should know the definition of mandatory bid rule, equal treatment, transparency, squeeze out, sell out, right? These are very important. Mandatory bid rule, it's a bit different wording. Squeeze out, sell out, right? You should know what is the meaning of that. Breakthrough rule is also important. General principles, competition commission. Okay. These are the points which are very important. Next, in valuation, assumptions are very important. I have written all the assumptions by the way. I have written all the assumptions. Free cash flow assumptions are important. These are the assumptions. These are the assumptions. You can write about the growth. You can write about the discount factor. You can write about the taxation. You can write about the investment. These assumptions are very important. You can read it. In almost in all of the question, you can write these assumptions, obviously by linking with the SNAP. It is assumed the level of free cash flow reflect the normal capacity. Assume that free cash flow will grow with the constant growth. Required return will remain constant. You have to write in paragraph and you have to write with your own wording. Yes, there is one more assumption you can write always. if you want to write, you can write it now. It is assumed that the cost related to acquisition is minimum. Why? Because cost related to acquisition is not given in the question. So you are assuming that it is not given. If it is not given, it should be minimum. So in AFM, in almost all the past paper question, cost of acquisition is never given. Why? In practical life, cost of acquisition will always be there. You need to hire the firm to do the due diligence. You need to hire the firm to, even the law firm, to properly integrate the company. So in practical question, we are not considering those. So guys, in almost in every part, I have given the assumptions. So please do read those assumptions. I think bookish, these notes are more than enough to prepare for the theory of merger chapter. Yes. Please open the second question. First, number one requirement is estimate the equity value of the combination of Propleis and Adeccan. So equity value of the combination of P and A company and the benefits which would be gained by Propleis shareholders from the acquisitions. 10 marks are there. B part, discuss the assumption made in the calculation A. Screen is showing, I think. Log out and re-log in. वकार दोबारा log in कर लो. Okay. Discuss the assumption made in calculation in part A, including whether the expected synergies are likely to be achieved. This is B part. You should be happy to read this part because you know how to answer this. We have just discussed it. C part, explain the action. This is important, guys. Explain the action which acquirer board can take to ensure that the companies are integrated successfully and synergies are realized. Okay, this is here. This is this answer. Let me open it. This is the answer. This page. This page. Obviously, you have to link with the scenario. Otherwise, this page is the answer. Explain the action which company board can take to ensure that companies are integrated successfully. Okay, let's read it. Propleis and Adeccan are two listed publishing companies. The main focus of both companies is publishing magazines, although they also publish a limited number of books linked to the magazines. Propleis company publishes property and lifestyle magazine, and Adeccan company publishes magazine covering professional sports. So guys, tell me, will they get any synergy benefits by just reading this highlighted lines? Is there any synergy benefits or strategic benefits? property and professional sports magazines. For example, you are the sports lover and you always read the sports magazine, and you went to the shop and shop owner will say, now we are also launching the property magazines. Will you be happy, or you will say, okay, I don't care? What should be your answer? सही वाला बताएं तो दिल में फीलिंग आ रही. Tell me the true feeling. You are the Formula One lover. You are the football or cricket lover. You always follow the sports stars, and your company, uh, your your publishing company is saying, now we are happy to introduce property magazine. No, lifestyle, even lifestyle cannot be linked with the professional sports. I'm not saying that your football or cricket stars or the Formula One racer are appearing in the ads. Don't link in that style. Don't care, na? Because they are not linked with each other. Okay, someone is saying lifestyle can be, sir, business will increase, so enhance. No, how business will increase? How business will increase? Okay, me and you are two customers. I read the property magazines. You read the sports magazine. I keep the boring stuff with me. I read the property magazine. You read the sports magazine. We both went to the shop, and now we are seeing that our companies has introduced both of these magazines. I still buy the property magazine. You will still buy the sports magazine. It will not create synergy because these are not linked with each other. These are not linked with each other. Okay. How they will link? If I'm covering the Formula One race of US and your magazine is covering the Formula One race of Europe, let's assume, or my magazine is covering the football of Europe, your magazine is covering the football of Africa, and we are combining together, then it will create the synergy. Yes, there will be operational synergy. I'm not talking about the operational synergy. I'm talking about the revenue synergy. There can be operational. Yes, operational synergy can be there because both of the magazines can be printed from the same machine. I'm not talking about the operational synergy. Guys, you got my point, that right? There will be no strategic benefit. It may, if they integrate into one magazine. What happened, people will start taking the interest. Because in half of the pages you will see property, and half of the pages will you will see sports. How can you sell this idea? People will stop buying your magazine if you combine property and sports together. Okay. Yes, if sports star is doing the marketing of some building, that is other thing. I'm not talking about that point. Here I was talking about different point. Okay. Idea where? Okay, let's move forward. Both companies publish a combination of magazine which have been established in recent years and some of which have been publishing for much longer. So some of the magazines are new and some of the magazines are old. Propleis company has an in-house team of staff writers and editors who are reasonable, who are responsible for content. Most are young and tend to stay for a limited time. This is important. So Propleis company staffs are young and stay for the limited time. Dick 10 Company is a team of in-house writer and editor for each magazine who are specialists in sports, which their magazines cover, and who in some cases have worked for the magazine for many years. For many years. Currently, successful sports stars are also write for the Dick 10. This is important. Sports staffs are also writing for the company. The Dick 10 Company board has given the managerial writing teams of the most successful magazines considerable autonomy. This is it. Autonomy is also provided. Both companies have an online presence in addition to the publishing paper copies of their magazines. Electronic subscriber for both companies can access some content which is only available online. Whereas Propleis company has won award for its online presence and e-marketing. A Dick 10 Company website has been criticized for looking old-fashioned, with the main appeal of its online offering being the high quality of the writing of the content, which is only available online. Okay, perfect. Propleis company is planning to make takeover bid for the Dick 10 Company and has contacted Dick 10 Company board. Propleis company board believes that acquisition could provide synergies, particularly in the area of online presence, marketing, and cross-selling. Cross-selling, guys. This word is important. We have discussed that cross-selling will not be happen because they are unrelated businesses. And also saving in staff. Yes, saving in staff and admin. Saving in staff. How will you save the staff? You have some editors who are the editors of property and lifestyle, and other editors are for the sports. Will they save from the staff cost? Guys, will they save from the staff cost? No, because you cannot ask the sports journalist, right, about the property. Yes, admin, you can save a lot of money from the admin and paper cost, because you can buy paper from one source and get the discount. This is important. This whole exhibit will help you in the B part. So we will open it later. So for A part, let's read it. Current market value of Propleis is $620 and Dick 10 is $340 million. Dick 10 Company board has indicated that its shareholder will get a premium of 20% above its current equity value. Propleis Company board feels that its shareholder will also expect a gain of at least 20% of the current value. Okay, both are hoping to get 20%. Propleis Company wishes to estimate the equity value of the acquisition with the free cash flow to firm. Free cash flow to firm. Estimated sales revenue in the first year when the companies are combined $720, and expected sales growth is 8% in 2 to 4 years. Post-tax operating cash flows in year 1 to 4 is 14%. Company requires additional investment in non-current assets, $25 million in year 1 and 0.3 for every $1 rise in sales from year 2 to 4. After year 4, expected annual growth rate of the company free cash flow is 4%. Cost of capital is 10%. Target debt equity ratio is 1:3. So I don't know why student can even imagine that this is a difficult question. It's a much, much easier question. So let's solve the A part. What is A part, by the way? Equity value of the Propleis, combined value. You will calculate the combined value, and benefits. You will calculate the gain for both companies. Part A. So let's calculate the combined equity value. So number one thing, first of all, you will make pro forma for 4 years a free cash flow to firm method. Let me write the sales first. In year 1, it is 720 and it will increase by 8% growth. 1.08 and copy it to the next 2 cells. Okay, now post-tax operating cash flows. That is 14%. Then investment capex. In first year, it is 25. And then change of sales into 0.3. Say operating cash flow is given, capex is okay. Then calculate the combined free cash flows. Okay. Next is, guys, discount rate is given 10%. And the long-term growth is given 4%. So present value of cash flows from year 1 to 4. NPV, bracket start, 10%, comma, 291. Present value of cash flows after year 4. Okay. Now, last year cash flow into 1.04 divided by 10% minus 4% into discounted with the 4-year discount factor. One to 64. Total business value. Total business value. 1556. Now calculate the combined equity value. Okay. Debt equity ratio is 1:3. That means 1 is debt, 3 is equity, total is 4. So debt is 25%. So the equity will be 75%. This is combined equity value. Deduct the Propleis current value, addicton, addicton current value. This is 620. This is 340. And synergy is 207. Synergy is 207. Debt equity ratio is 1:3. Debt is 1. Equity is 3. Total is 4. So this is 1:4, 25%. This is 3:4, 75%. So equity is 75%. Okay. Now calculate the benefit of addicton company. How much they are demanding? 20%. 20%. 68, right? And what is the remaining benefit? Remaining benefit to Propleis company. So total benefit for 207, we have distributed 68 to the adductant, so remaining is 139. Remaining is 139. It is written in the question that adductant company will get 20% benefit of their current value. So their current value is 340. So I multiply 20 to the 340. So 68 will be distributed to the adductant company. Remaining will be distributed to the Propleis company. And how much percentage earning benefit. So Propleis companies are earning 139 million and their current value is 620. So they are earning 22.49%. 22.49%. Synergy value is very easy. Calculate the combined equity value and deduct the current values of Propleis and adductant company. You can calculate the synergy value. Okay. Let's move to the theory and I need your help that how to write the theory. B part. Discuss the assumption made in the calculation, including whether the expected synergies are likely to be achieved. Guys, please tell me, how will you write this theory? First of all, tell me the assumptions. Anyone? Okay. Examiner has used the word discuss. So you will not write that it is assumed that growth rate is 4%. You will not get any number for that. You have to discuss the validity of the assumptions. Otherwise, you will not get any mark. Remember, you have to write according to the skepticism and professional acumen. So now tell me. First of all, come to the sales. Expected sales revenue in the first year is 720 million. The sum of the sales revenue of the two companies for the most recent financial year. And expected sales growth in each of the 2 to 4 year is 8%. Yes, you are right. You're right. We can say that, we can write that. It is assumed that sales growth rate will be 8% in the first 4 years. And the margin and capex all are constant in the first 4 years. But as the company is operating in publishing business, so the demand of the magazine and demand of the user can change over the period of time, because now there is a online presence of the business as well. So it is difficult to maintain the sales growth, margins and capex over the longer period of time. You can write that. And you can also write that it is also assumed that company cash flows will remain constant for the foreseeable future at 4%. This is quite unrealistic. Maybe some of the magazines have a long history, but some of the magazines are newly introduced here. So it is quite difficult for the company to maintain this over the longer period of time. You can also write this. Then the most important part, remember, whenever we apply the free cash flow to firm, we always calculate the WACC. How this cost of capital is calculated? It is the cost of capital of the acquirer, it is the cost of capital of the target, or it is a combined cost of capital. No information is given here. So we are relying on this given cost of capital. How this has been calculated, the whole information is missing. There is no information about the business risk, financial risk, or the capital structure of the combined business. Only one statement is given that target capital structure will be this. If company fails to achieve this target capital structure, what will happen? What will be the impact on the 10%? You can write this. Okay. One of the student has written stable growth rate of 4% can only be expected in stable economy and industry. Yes, you can write that. You can also write that in tech related, in technology or online business, stable growth rate is difficult to achieve. Next. One more point. Propleis company also wants the 20% benefit. And that is equal to 124. Now you are earning 139. But this 139 is heavily dependent upon the figures which we have taken from the scenario. If by any chance company fails to achieve these figures, the benefit accruing to the Propleis can fall. So what should company do? It was written in the question that Propleis also wants the 20% benefit. So I have taken 20% of 620. That is 124. So the required benefit is 124. Currently scenario is given you 139. Currently scenario is giving you 139. But what will happen if company fails to achieve this? Because all this based on the future data, right? So what company should do? Company should also do the sensitivity analysis of these figures, of these assumptions. And one more point, cost of acquisition is also not given. Whenever two companies are combining, there can be a huge cost of acquisition, which is assumed to be nil here. Okay. Now please tell me the second part. Are you expecting the synergies is likely to achieve? Are you thinking that synergy will achieve? Not all. Yes, you will write that some of the synergies are realistic, they are quite possible to achieve. For example, the paper cost, for example, the admin cost, for example, the some kind of online presence, because one of the company has won some awards for the online presence, for online marketing. So it will create synergy benefits and it will give you the benefits. But the other synergies are difficult to achieve. For example, you will unable to save from the staff cost, because all the staffs are specialists, all the editors are specialists. They can't do the other work. They can't do the work for other magazines. If sports editor, he can't work for the property magazine. Property editor cannot work for the sports magazine. You cannot save from the staff. You cannot save from the cross-selling. You cannot sell sports on the property magazine, and you cannot sell the properties on the sports. So that's the limited kind of benefit from cross-selling and saving from staff. And other thing, There will be no economies of scale. Okay. Now, what was the last part, by the way? What was the last part? Explain what action this Propleis company board can take to ensure the companies are integrated successfully. Now, please tell me what action you will take. What action you will take? Anyone? Say few points. You want to make this successful. What action you will take? Thorough investigation, thorough due diligence. If you do the thorough investigation, thorough due diligence, you can identify the possible sources of synergy. You can smoothly run the integration. And second, if you identify the key staff, you will start contacting those staff even before the acquisition. You can ensure those staff, those editors, that you will keep them comfortable. You will give them the comfortable position. You will give them the benefits, perks and benefits, so that they may not leave the business. So you will keep communicating with the adjacent staff. And plus, you can also communicate with the sports star journalist. There are some sports star editors in that company. So you will contact them and you will smooth your relation with them. You can ask them that when you acquire the business, they will still in the list. Okay. You will make some good plan to integrate the business. Thorough due diligence, proper investigation, proper valuation, smoothly integration process, contacting the staff so that staff may not leave the company. These are the common points which you will ensure that your merger acquisition process can run smoothly. Okay. And Propleis company can also consider this one point that you should give the enough time to smoothly complete the process. Let me explain you with the help of an example. This is my company example, by the way. So let me help you to understand this concept. I work in a bank in Pakistan. I'm the head of sales there. This is my bank. And we want to acquire HSBC Pakistan operation. Not the HSBC of the world, HSBC Pakistan operation. Mizan is an Islamic bank, purely Islamic bank. HSBC is a conventional bank. You people know that. So Mizan wants to acquire the HSBC. So how they acquire the HSBC? They directly identify the key staff. They take the list from the HSBC, identify. HSBC, by the way, is a multinational bank. Identify the key staff and make a list that which staff they will retain at which position and which staff they want to release. Number one thing. Second, now Islamic banking is integrating with the conventional banking. It is very difficult to integrate these two. This is Islamic bank. This is conventional bank. Both are integrated. It is like two different religion persons are integrated. You know how difficult it is. So they spend a lot of time with experts which were handling this integration process. So they spend a lot of time. What is the solution of integrating two different businesses, two difficult businesses? Hire experts, spend a lot of time, do some research, and then integrate, so that in future you may not feel the pressure, you may not face the problems. That's a solution. Okay, that's the way you will avoid the problems. Thorough investigation, thorough due diligence, make a proper valuation method so that you can identify the other companies. Here, your focus should be retaining the key staff. Your focus should be to combine the businesses in a smooth way. That's how you will write it. Okay. Guys, you will also write that when Propleis company is acquiring the Adecton company staff, you should keep in mind that Adecton staffs are working there for a long time. So you should also make such policies, such a comfortable environment that to attract the Adecton company staff, so that they can also work smoothly for a longer time in your company. Second, what is the success story of the Adecton? They have given the managerial and writing team the autonomy. The Propleis company should also keep in mind that they also have to give the autonomy to the other company. Okay. Right. Second, Propleis Adecton company's website has been criticized for looking old-fashioned, and Propleis company website has won award for its online presence. So it will be difficult for the Adecton company staff to learn this innovative website or e-marketing. So they will take time. Propleis company should also keep this into mind. Okay. Take care, guys. See you tomorrow at 7 p.m. evening time, 7 p.m. Pakistan time. Last two classes or the last one class?